Welcome to BookBytes. Today, we embark on a journey into the fascinating world of Warren Buffett, one of the most successful investors of all time. In his book, The Warren Buffett Way, author Robert G. Hagstrom explores Buffett's investment philosophy and strategies. Let's dive into the introduction in Chapter 1, where we first encounter the genius mind of Warren Buffett. Chapter 1, The Legend. Warren Buffett's unparalleled success in the world of investing has made him a legend. He is known for his immense wealth, humble demeanor, and remarkable ability to consistently outperform the markets. In this chapter, we begin to understand what sets Buffett apart from other investors. Buffett grew up in Omaha, Nebraska, in a middle-class family. At an early age, he displayed exceptional aptitude for numbers and finance. He often spent his time reading financial books and analyzing stock market reports, already showing a deep understanding of investing. Despite his young age, Buffett was determined to learn from the best. He relentlessly sought knowledge and sought out his mentor, Benjamin Graham, a renowned investor and author of The Intelligent Investor. Graham's teachings left a profound impact on Buffett's investment philosophy, shaping his views on value investing. Buffett's fascination with investing grew as he immersed himself in the study of profitable businesses. He discovered that by purchasing stocks that were undervalued but had potential for long-term growth, he could generate substantial returns. Buffett's strategy involved examining a company's fundamentals, such as its earnings, cash flow, and market position. This deep level of analysis allowed him to make informed investment decisions and select companies with strong intrinsic value. He often likened investing to playing baseball, emphasizing the importance of patience and waiting for the right pitch. Buffett understood that timing was crucial and that jumping into every opportunity was a recipe for disaster. His patience and discipline ultimately led to his incredible success. Warren Buffett's investment principles are not solely focused on financial analysis. He also emphasizes the value of integrity and sticking to his beliefs. He never invests in a company he doesn't understand or in a management team he cannot trust. This unwavering commitment to his values guides his decision-making process, making him a revered figure in the investment community. In conclusion, Warren Buffett's story underscores the importance of knowledge, discipline, and sticking to one's values. In this chapter, we have only begun to scratch the surface of his profound strategies. As we continue delving into The Warren Buffett Way, we will explore his portfolio management techniques, his ability to find undervalued companies, and his distinctive approach to risk assessment. Chapter 2, The Science of Stock Selection. Here we explore the fascinating world of analyzing and selecting stocks with calculated precision. As we dive into this chapter, we discover that Warren Buffett approaches stock selection as both an art and a science. He isn't merely an impulsive gambler, but a patient, strategic investor. He believes in the principle of buying a piece of a business, rather than mere stock certificates. When evaluating stocks, Buffett looks for companies whose performance revolves around solid underlying factors, such as durable competitive advantages, known as moats. These moats can be in the form of brand recognition, patents, or economies of scale. Buffett has always stressed the importance of investing in businesses one understands. This way, the investor can properly assess the company's present and future potential. Staying within one's circle of competence helps to minimize risk and make informed decisions. In his pursuit of a promising investment, Buffett relies heavily on financial data like annual reports, balance sheets, and income statements. Through his extensive research, he identifies companies that possess consistent, positive cash flow, stable earnings growth, and a healthy return on equity. While financials provide essential insights, Buffett believes in understanding the qualitative aspects of a business as well. He looks for companies with strong management teams that demonstrate integrity and have a vested interest in the success of the business. The legendary investor also discusses the principles of intrinsic value and margin of safety. He often illustrates this concept by comparing the stock market to owning a farm. If one could determine the true worth of the farm and buy it for a significantly lower price, then that is an opportunity worth seizing. An essential element in Warren Buffett's investment philosophy is patience. He encourages investors to adopt a long-term perspective and not be swayed by short-term market fluctuations. Buffett firmly states that if one is not willing to hold a stock for 10 years, they shouldn't hold it for 10 minutes. Additionally, Buffett highlights the importance of focusing on the downside risk. He advises investors to prepare for worst-case scenarios and always have a backup plan. By considering potential risks before investing, one can avoid severe pitfalls and protect their hard-earned capital. To sum up Chapter 2 of The Warren Buffett Way, we learned that successful stock selection involves a combination of thorough research, understanding the qualitative aspects of a business, assessing intrinsic value, and always maintaining a margin of safety. Buffett's patient, long-term mindset has secured his place among the greatest investors in history. Chapter 3 is a crucial chapter in understanding Buffett's investment philosophy. In this chapter, Hagstrom takes a deep dive into Buffett's approach in determining the intrinsic value of a company before making any investment decisions. Let's jump right in. To determine the intrinsic value, Buffett looks at a company's financial statements, including its balance sheet, income statement, and cash flow statement. He analyzes these figures meticulously to assess the company's real value. But the key lies in understanding what exactly he is looking for. Buffett focuses on various key factors, such as earnings growth, return on equity, and debt levels. He believes that companies with consistent earning growth are more likely to generate higher returns over time. Additionally, he looks for companies with a strong return on equity, indicating a profitable and well-operated business. Keeping a close eye on the debt levels is crucial to ensure the company's financial stability. Buffett's approach to valuation is often described as the discounted cash flow analysis. He calculates the present value of a company's expected future earnings and cash flows. This allows him to estimate the intrinsic value of the business, helping him identify potentially undervalued investment opportunities. The discounted cash flow analysis incorporates several variables, such as projected earnings growth rate, required rate of return, and the number of future years the analysis covers. Buffett carefully considers each variable to ensure accurate valuation. Now, here's where the concept of margin of safety comes into play. Buffett always seeks a considerable margin of safety when investing. This means that he purchases stocks at a price significantly below their estimated intrinsic value, ensuring a buffer against any uncertainties or potential errors in his calculations. It's crucial to note that Buffett relies on a long-term investment approach, emphasizing the importance of holding on to investments for years, even decades. He believes that the short-term market fluctuations do not reflect a company's true value and that patience is key to realizing significant returns. And that wraps up Chapter 3 of The Warren Buffett Way. We've explored Buffett's method of determining the intrinsic value of companies and the significance of the margin of safety. Chapter 4, Investment Philosophy and Portfolio Management. Chapter 4 opens with Warren Buffett stressing the importance of having a well-defined investment philosophy. He emphasizes that successful investing doesn't rely on simply buying and selling stocks but on understanding what you own and why you own it. Buffett places great importance on value investing, the practice of finding undervalued stocks. He looks for companies with strong fundamentals that are trading at a discount to their intrinsic value. This is crucial in reducing the risk of losing money in the stock market. Buffett explains that identifying excellent companies with sustainable competitive advantages, or moats, is the foundation of his investment strategy. He searches for businesses with strong and durable economic moats that protect them from competitors and allow them to thrive over time. Another key aspect of Buffett's investment philosophy is his focus on long-term investing. He believes that owning stocks should be regarded as owning a piece of a business. Instead of following market trends, he encourages investors to think like business owners and have a patient approach. Buffett also stresses the importance of understanding the businesses you invest in. He recommends investing in industries and companies that you can comprehend and have a deep knowledge of. By doing so, you can make informed decisions based on your understanding of the underlying business. In terms of portfolio management, Buffett advises investors to focus on a concentrated portfolio of their best ideas rather than diversifying too much. He believes that diversification is only necessary when you don't know what you're doing, and it hampers the potential for significant gains. Additionally, Buffett emphasizes the significance of having a margin of safety, buying stocks at a price below their intrinsic value, thus protecting against downside risks. This principle allows investors to minimize losses and increase the chances of generating long-term returns. Lastly, Buffett highlights the importance of maintaining discipline and not succumbing to market emotions. He advises investors to stay calm during market fluctuations, avoid the herd mentality, and be willing to go against the crowd when necessary. This chapter reveals the essence of Warren Buffett's successful investment approach, emphasizing value investing, long-term thinking, understanding businesses, and maintaining discipline. Chapter 5: The Inner Circle. In this chapter, Buffett emphasizes the importance of surrounding oneself with the right people, the inner circle. He firmly believes that a company is only as strong as its management team. Warren Buffett and his trusted partner Charlie Munger together form a dynamic duo, often referred to as the Oracle of Omaha. Buffett understands that having wise and competent people around you can directly influence your investment success. Let's take a look at some of the key members in Buffett's inner circle. Firstly, we have Berkshire Hathaway's vice chairman, Charlie Munger. He brings a unique perspective to the table, challenging Buffett's assumptions and enhancing his decision-making process. Munger is known for his quick wit, emphasis on rationality, and his ability to think outside the box. His strong partnership with Buffett creates a conducive environment for critical discussions and valuable insights. Next, we have Ted Weschler, one of Berkshire Hathaway's portfolio managers. Buffett's trust in Weschler's ability to make astute investment decisions is evident in the significant funds he manages on behalf of the company. Buffett often reveals how invaluable Weschler's perspective is when analyzing potential investments. Their intellectual synergy enables a thorough analysis and discussion of potential opportunities. Another notable member of the inner circle is Ajit Jain. Jain serves as the vice chairman of insurance operations at Berkshire Hathaway and is highly regarded for his ability to manage risks effectively. Known for his analytical thinking and deep understanding of the insurance industry, Jain specializes in underwriting techniques that have contributed significantly to Berkshire Hathaway's success. These are just a few examples from Buffett's inner circle, highlighting the diverse skill sets and expertise that Warren Buffett surrounds himself with. By forming this inner circle, Buffett ensures that he has a collective brain trust, allowing him to tap into different perspectives and reduce blind spots. These individuals challenge his assumptions and help him navigate through complex investment decisions. It is this inner circle that has played a pivotal role in Warren Buffett's remarkable success over the years. Surrounding yourself with intelligent, trustworthy, and complementary individuals is key to achieving greatness, both in business and in life. Thank you for joining us today on our exploration of the Warren Buffett Way. Make sure to subscribe to our channel for more insightful episodes on investment strategies and the wisdom of great investors like Warren Buffett. You can purchase the book from the link given in description.